Eni's Q2 2025 results highlight strategic resilience and strong execution. Despite commodity and currency challenges, Eni achieved €2.7 billion pro forma adjusted earnings before interest and taxes, and €1.13 billion adjusted net profit. Key initiatives include a 20% investment in Plenitude by Ares, a joint venture with global infrastructure partners for carbon capture, utilization, and storage, and the Argentina liquefied natural gas project with Yacimientos Petrolíferos Fiscales, enhancing Eni's gas, liquefied natural gas business. Eni's Q2 25 production decreased by 2.6% year-over-year due to portfolio activity, but increased 1.3% sequentially. Azul Energy announced discoveries in Namibia and Angola. Eni and Petronas formed a joint venture targeting 500,000 barrels of oil equivalent per day production. The Argentina liquefied natural gas project aims for 30 million tons per year by 2030. Renewable capacity reached 4.5 gigawatts, and biorefining capacity is 1.65 million tons per annum. Eni is enhancing its 2025 financial outlook, increasing cash flow from operations to approximately €11.5 billion, a €0.5 billion improvement. Cash initiatives are raised to €3 billion to counteract market challenges. Global gas and power's earnings before interest and taxes projection is now €1 billion due to successful renegotiations. Capital expenditures is reduced, maintaining oil and gas production at 1.7 million barrels of oil equivalent per day. Shareholder returns include a 5% dividend increase and a €1.5 billion buyback program. In Q2 2025, hydrocarbon production averaged 1.67 million barrels of oil equivalent per day, a 3% decrease from the previous year, mainly due to divestments in Nigeria, Alaska, and Congo. Liquids production rose by 6% to 825,000 barrels per day, driven by growth in Côte d'Ivoire and Mexico. Natural gas production fell by 9% to 4,415 million cubic feet per day, with declines offset by growth in Congo, Italy, and Indonesia. In the second quarter of 2025, the segment's adjusted net profit was €1,059 million, a 20% decrease from the second quarter of 2024, with contributions from joint ventures like Vår Energy and Azul Energy. The tax rate dropped to 46%, driven by a favorable geographical mix. Strategic developments include discoveries in the United Kingdom, Norway, and Côte d'Ivoire, and new projects in Indonesia and Angola. In Q2 25, natural gas sales decreased by 4% to 9.01 billion cubic meters, with European sales stable due to increased sales in Benelux, Iberian Peninsula, and the United Kingdom. Thermoelectric production rose by 8% to 4.53 terawatt-hours, driven by higher plant utilization. The global gas and LNG portfolio achieved a pro forma adjusted earnings before interest and taxes of €321 million, slightly lower than 2024, while power generation earnings before interest and taxes increased by €44 million due to a contractual renegotiation gain. In Q2 2025, Eniliv's bio throughputs decreased by 16% due to maintenance at Gela and Chalmette. Retail sales rose by 4% in Italy, driven by gasoline and diesel. However, wholesales in Italy fell by 27% due to lower product availability. Despite stable pro forma adjusted earnings before interest, taxes, depreciation, and amortization, low biofuel margins impacted earnings before interest and taxes. Oh, the mystery of margins. Though European biorefining spreads are recovering, Plenitude's retail and business gas sales decreased by 7% in the second quarter of 2025, mainly due to a reduced customer base in Italy and France. However, renewable energy production rose by 23%, driven by new projects and acquisitions. Installed renewable capacity reached 4.5 gigawatts, reflecting growth in Spain, the United States of America, the United Kingdom, and Italy. Electric vehicle charging points increased by 7% to 21.8 thousand. In June, Eni agreed to sell its 20% stake in Plenitude to Ares Management for €2 billion, valuing Plenitude at €10 billion. Plenitude also initiated a solar project with Modine in Paceña, generating 1.8 gigawatt-hours annually. Additionally, the Renapool plant in Spain began operations with a 130-megawatt capacity, expected to produce over 265 gigawatt-hours annually. In Q2 2025, the refining business nearly broke even, recovering from weaker margins earlier in the year. The chemical sector, managed by Versalis, reported a €184 million pro forma adjusted loss, improved from the previous year due to reduced feedstock costs. Versalis also launched the Hope Technology demonstration plant for recycling mixed plastic waste, enhancing sustainability efforts. Eni's strategic achievements include the Liverpool Bay CCS project financial close, advancing CO2 transport and storage. In Angola, Eni signed memorandums of understanding to enhance pediatric healthcare and digital hospital coordination. Eni also entered exclusivity with global infrastructure partners for a 49.99% stake in Eni carbon capture, utilization, and storage holding, supporting carbon capture, utilization, and storage projects. Additionally, Eni launched initiatives in supercomputing, vegetable oil exports, and a new European long-term investment fund for energy tech investments. In the second quarter of 2025, Eni's pro forma adjusted earnings before interest and taxes decreased by 35% to €2,681 million, impacted by lower crude oil prices and currency fluctuations. Despite this, the exploration and production business showed improvements due to a better volume mix and cost efficiencies. The global gas and power segment increased by 9%, driven by gas portfolio maximization. Overall, adjusted net profit attributable to shareholders fell by 25%. In the first half of 2025, net cash from operations was €5,902 million, including €879 million in dividends from equity investments like Azul Energy. Adjusted net cash before working capital changes was €6,189 million, accounting for inventory gains, gas inventory timing differences, and decommissioning provisions. These figures reflect Eni's strategic financial management and optimization efforts. In the first half of 2025, Eni's organic capex was €3.9 billion, with free cash flow before working capital at €2.3 billion. Acquisitions focused on renewable energy and agri-business expansion. Financing cash flow included €3.6 billion from KKR's investment in Enilive. Net borrowings decreased by €2 billion, supported by operating cash flow and divestments. As of June 30, 2025, Eni's fixed assets decreased by €9 billion, primarily due to exchange rate impacts. Shareholders' equity fell by €2.2 billion, influenced by currency translation and shareholder remuneration. Net borrowings before lease liabilities dropped by €2 billion, with leverage at 19%. Pro forma leverage is projected at 10% with ongoing disposals. Special items in operating profit include net charges of €443 million in exploration and production due to asset write-downs and reserve revisions. Gas and power saw net gains of €517 million from commodity derivatives. Enilive and Plenitude faced €334 million in charges, while refining and chemicals incurred €319 million in write-downs and environmental provisions. Eni's quarterly and half-yearly results for 2025 are prepared under international financial reporting standards, consistent with peers, providing regular updates on financial and industrial performance. The interim report, due in August, follows Italian listing standards and is reviewed by external auditors. Non-generally accepted accounting principles measures are explained per European Securities and Markets Authority guidelines, ensuring transparency in financial reporting. Management uses non-GAAP financial measures like adjusted operating and net profit to evaluate business performance. These exclude inventory holding gains losses, special items, and finance charges. This approach aids in comparing performance across periods and aligns with analysts' forecasting models. Non-GAAP measures complement IFRS data, offering a clearer view of trading performance. Net borrowings are calculated by subtracting cash, cash equivalents, and non-operating financial assets from total finance debt. Pro forma adjusted earnings before interest and taxes includes the operating margin of equity accounted entities, reflecting contributions from joint ventures and associates. Reconciliation tables align non-generally accepted accounting principles results with generally accepted accounting principles measures, ensuring transparency in financial performance reporting. In the second quarter of 2024, Eni reported an operating profit of €1,581 million. Adjustments for inventory holding gains and special items, including environmental charges and impairment losses, resulted in an adjusted operating profit of €3,185 million. The adjusted net profit attributable to Eni's shareholders was €1,519 million, reflecting significant financial adjustments and strategic management decisions. In the first half of 2025, the recorded operating profit was €3,490 million. Adjusted operating profit of subsidiaries reached €4,489 million, with a pro forma adjusted earnings before interest and taxes of €6,362 million. Adjusted net profit attributable to Eni's shareholders was €2,546 million, reflecting a tax rate of 46.9%. Special items and inventory holding gains significantly impacted these figures. In the first half of 2024, Eni reported an operating profit of €4,251 million. Adjustments for inventory holding gains and special items, including environmental charges and impairment losses, resulted in an adjusted operating profit of €6,212 million. The adjusted net profit attributable to Eni's shareholders was €3,101 million, reflecting strong performance across various segments. In Q1 2025, Eni's adjusted operating profit reached €2,600 million, with significant contributions from exploration and production and global gas and LNG portfolio. Special items, including environmental charges and impairment losses, impacted results. Adjusted net profit attributable to Eni's shareholders was €1,412 million, reflecting a 47.1% tax rate. This performance underscores Eni's resilience amid market challenges. Special items significantly impact operating profit, with environmental charges and impairment losses being major contributors. In the first quarter of 2025, environmental charges were €163 million, while impairment losses reached €323 million. Commodity derivatives and exchange rate differences also played roles, affecting the overall financial landscape. Understanding these elements is crucial for accurate financial analysis and strategic planning. The reconciliation of GAAP versus non-GAAP profit and loss for 2025 highlights key adjustments. Operating profit increased from €1,162 million to €1,889 million. After accounting for stock profit, special items, and finance expense reclassification. Net profit attributable to Eni's shareholders rose from €543 million to €1,134 million, reflecting these adjustments. These figures underscore the impact of financial reclassifications and special items on reported results. Sales from operations in the first quarter of 2025 show a mixed performance. Exploration and production decreased by 19%, while global gas and liquefied natural gas portfolio and power increased by 4%. Enalive and Plenitude saw a 10% decline. Operating expenses rose by 11%, with significant increases in impairment losses. Depreciation and amortization decreased by 5%, reflecting cost management efforts. Leverage is a key metric for assessing indebtedness, calculated as net borrowings over shareholders' equity, including non-controlling interest. As of June 30, 2025, total debt decreased to €29,105 million, with net borrowings after lease liabilities at €15,906 million. Leverage ratios improved to 0.19 before and 0.30 after lease liabilities, indicating a healthier balance sheet. A balance sheet reveals a decrease in total assets from €146,939 million to €136,210 million. Current assets declined, notably in trade receivables and inventories. Non-current assets also saw reductions, particularly in property, plant, and equipment. Liabilities decreased, with significant reductions in trade payables and long-term debt. Shareholders' equity fell, driven by changes in retained earnings and currency translation differences. In the first quarter of 2025, total revenues reached €22,964 million, a decrease from €23,057 million in 2024. Operating profit stood at €2,328 million, down from €3,490 million. Finance income was €2,248 million, while finance expenses were €2,487 million. Net profit attributable to Eni's shareholders was €1,172 million, with basic earnings per share at €0.36. The comprehensive income for 2025 shows a net loss of €3,269 million, primarily due to significant currency translation differences of €3,974 million. Items not reclassified to profit or loss include remeasurements of defined benefit plans and changes in fair value of interests. Total comprehensive income attributable to Eni's shareholders is a loss of €3,123 million. The group cash flow statement for Q1 2025 shows a net profit of €561 million. Adjustments include €1,873 million in depreciation and €318 million in impairment losses. Cash flow from changes in working capital was €1,176 million, with significant contributions from trade receivables. Net cash provided by operating activities totaled €3,517 million, while investing activities resulted in a net cash outflow of €2,236 million. In the first quarter of 2025, capital expenditure totaled €1,819 million, with significant investments in exploration and production, particularly in oil and gas development across the United Arab Emirates, Indonesia, Libya, Egypt, Italy, and Congo. Enalive and Plenitude focused on renewable energy and electric vehicle infrastructure. Refining and chemicals invested in Italy's Livorno biorefinery and circular economy projects. In Q1 2025, Eni's oil and natural gas production reached 1,668,000 barrels of oil equivalent per day, with significant contributions from North Africa and Sub-Saharan Africa. Liquids production was 825,000 barrels per day, while natural gas production was 4,415 million cubic feet per day. Joint ventures and associates played a crucial role, contributing 431,000 barrels of oil equivalent per day to the total production. This highlights Eni's diverse geographical footprint and strategic partnerships. Sustainability performance in the first half of 2025 shows significant improvements. The total recordable injury rate decreased to 0.48, with no fatalities. Direct greenhouse gas emissions aligned with decarbonization goals, and operational oil spills reduced to 11 barrels. re-injected production water increased to 55%, driven by operations in Turkmenistan and Mexico.